Thank you, everyone. Welcome to this afternoon's panel with, I guess, two legends of the space. It's aptly called Crypto Chronicles, and I couldn't think of two individuals better suited to chronicle the history of crypto, the crypto world, and probably also its future in many different ways. We've got Chris, the founder of Placeholder, and correct me if I'm wrong, is one of the leading early stage, so venture-oriented investment firms in the space, backing projects very early, thinking in different lines around teams and mechanics and markets and the ecosystem. So certainly someone that knows much better than most how to play the game and to think about the space. He also used to run ARK's crypto efforts in the very early days, so a true pioneer. And I remember when I got into the industry, he published the major first valuation guide or attempt at valuation of crypto universes, networks, and micro-monetary regimes. So welcome. Then we got Mik, the founder of Dapper Labs, which also happens to be a portfolio company, full disclosure. Mik co-founded the firm some years ago, spun it out of Axiom Zen in Canada, and has certainly been one of the pioneers of not just blockchain, but also entertainment on the blockchain, which is interesting to note, and always been one of my angles thinking about it, that it's a lot about fun and the fun on-ramp into the world of decentralized networks. So with that, let me start with a bit of an intro question to both of you. How did the two of you get into crypto and decentralized networks? What motivates you? What motivated you? And maybe something has changed on that perspective, Chris?
Sure, and thank you. Pretty simple. What got me into it was a fun application. I was in college at the time. The Silk Road was a novel marketplace where you could buy and sell anything online. And it just so happened to use this digital currency called Bitcoin. And, I guess for me that was informative and remains informative of the power of a useful application to bring people to these, say, nerdier underlying protocols that enable them, but you still need the application that is of use to the end user to bring, say, your average user on board.
For me it was my now co-founder and best friend, Roham, called me up when I was on vacation, and he said, he was running a venture studio. He said, hey, we're going to start building on this new platform, Ethereum. Come over here, get off your lazy ass. It's going to be really big. And I just started reading about it. At first, I couldn't understand anything. It was using lingo that I couldn't understand. And finally, I got this aha moment that this technology and the Ethereum platform and other platforms like it could fundamentally change the way we interact with the blockchain, changing the power dynamics from what I believe today Web 2 is us living in dictatorships to one where we live in a democracy. And actually, your guys' thesis on the FAT protocol helped me kind of get to that aha moment, so thanks for that.
You're welcome.
That would have been one of my next questions, and maybe picking that up. FAT protocols was the idea in the earlier years. So what I'm trying to ask is, Chris, when you look back and to when you started and to now, how is your perspective on networks, on decentralized technologies change? Is it identical? Is there an evolution in your thinking around them?
Yeah, there's been a ton of evolutions. I mean, I think you would almost have to go major network by major network. Even if you just look at Bitcoin itself, Bitcoin started, the white paper by Satoshi is a peer-to-peer cash, but it's a fixed supply asset that serves as a store of value that if you empirically study it is not used as much as a transactional medium as much as it's used as a store of value. And so even that thesis around Bitcoin itself has changed in the time I've been in the industry. I remember actually doing work with Coinbase in 2015, I think it was, and we were looking at their user behavior, and it just kept popping up that users were not transacting in Bitcoin, and that was violating the thesis at the time. But what it did turn out is users were buying and holding Bitcoin for long periods of time as a store of value. And so, again, if you follow the data and you're honest with yourself, I think you end up, the good thing with these protocols is because the data is open and transparent, they will end up revealing to themselves, they will end up revealing to you, how they're being used. So that would be Bitcoin. Ethereum has almost gone in a not quite an opposite direction, but like Ethereum started off where ETH wasn't supposed to be valuable, supposed to be a digital oil, would be one way that it was verbalized early on. And then as it has added utility, as you can now stake it as a part of its consensus process, ETH has transformed into a capital asset that's yielding, that's also a type of savings technology. But then, teams can build any kind of abstract logic on top of that network. So I guess there's almost too much that's changed to try and say broadly. But one thing that I would say that remains the case is you need compelling applications. And so even if the protocols are going to absorb a lot of the value, that doesn't give us an excuse to not focus on the application layer. And Placeholder's been spending a lot of its venture investing time at the application layer last year and this year, precisely because crypto needs more compelling applications on top of the protocols to convert users into this world.
Now, one is the idea of utility of an application, which I think I completely understand. How do you see the value accrual perspective for investors? That is a bit of that endless and I assume unsolvable debate. Where does value medium term really accrue versus where is value played out to a user through an application? In other words, the investor perspective versus the user. Where do you see that as a firm or you individually? Where do you expect most investor value to accrue?
Sure. Well, I think in this case you have to define the investor type, and so I would say part of the power of crypto is de-emphasizing professional investors like myself, right? If you look at Bitcoin, it's a global, say, savings technology that was launched without any venture funding, right? And even Ethereum itself didn't strictly need any VCs to get off the ground, the crowd sale they did. And so part of the promise of crypto, as compared to, say, traditional Silicon Valley, is that you need less venture capital in order to launch these global networks. And in de-emphasizing the role of professional investors, you open up space for a bunch of other stakeholders to participate in the value creation of a network. Now, that's the promise. The reality is often different from the promise of crypto. I would say Web3 has been such a gold rush that you have lots of professional investors that have come in. And you've also had regulatory action, in particular in the US, for example. The SEC basically stomped out ICOs after 2017. ICOs were abused, but they were also used for good in allowing anyone to participate in the financing of a network. And is it better to have that, or is it better to have everyone going to VCs for the early stage financing? I would argue it's better for everyone to have access, even if there are situations where that goes south. It's better to preserve the access for everyone rather than cut off the access entirely. So that's from the investor perspective. In terms of like strictly value accrual, it's all going to come down to transaction fees and demand, and people actually using these networks. Right now, because you create your own capital, teams can be supported by annual supply inflation, which kind of covers over the lack of transaction fee demand, but it will all go back to the demand side and what do people pay for to actually use.
Got it. We might come back to that later, but let me move over to Mik. How has your perspective changed on the world you're operating in?
Yeah, I think that we just thought it was. So when we created CryptoKitties, we thought we were a lot further down traction than we actually are. And so our perspective is still that it's very, very early, that we still haven't found the killer use cases, and that we need to continue to develop new applications. I don't completely agree that, I believe in the FAT protocol thesis. I do believe that value can be captured both at the protocol layer and at the application layer by delivering value to consumers. And I think both need that value to be delivered for our industry to grow. But I do think that we've seen a lot of growth. Like, we're in a downturn right now, but if you compare where we are today to 2019, in 2019 we had about 100,000 people who had used a decentralized app, and maybe 10,000 weekly active users. We've grown by orders of magnitude. Probably at least 100 million of people have interacted with the blockchain itself. We're in the millions to tens of millions of weekly active users, and so we've had orders of magnitude of growth. I expect there to be more orders of magnitude of growth, specifically because we've got more VCs like Chris kind of investing in the application layer, and we've got much more talent coming into our industry.
The application layer and that thinking is relevant. Chris Dixon just published a book called Read, Write, Own, I think, where he tries to to push out a manifest on the utility of decentralized technologies. Yet critics have been pretty fierce to point out a lot of logical flaws in the argument around what the necessity for decentralized technologies are, decentralized solutions. What are your views, Chris, on the problems being solved, that endless question that's been debated, and that's always been debated in downturns more fiercely than in upswings, because people then tend to look for fingers to point or pointers to point at. So what's in short, what do you think around the real problems being solved through crypto?
Sure. Well, first I would say when you see everyone hating on crypto is generally the best time to build or buy in the ecosystem. But in terms of the problems being solved, I'm going to just focus on the data component. And if you look at the history of information technology, you tend to have these regimes where there's a golden goose of the industry that becomes proprietary, and that eventually it's an open standard that unlocks the market power around that golden goose. And so we've gone through a hardware era and a software era, and we're currently in a data era where the golden goose is data. And Google, Apple, Facebook, Amazon, all these companies in different ways control the user's data. And even if we are the ones creating it, and we can technically export it, we're not able to flexibly authenticate the way in which our data is used, and this is going to become more and more important as AI becomes more of a thing in our day-to-day lives. And so what blockchains do is they're these open data systems. So it's an open standard that unlocks the market power, unlocks the golden goose of what's currently, I would say, killing innovation within Web 2, and ends up putting control of the data back into the user's hands. And then what you get to do with that is really where a lot of the interesting experimentation is coming about in Web 3. And the interesting thing is the big Web 2 players actually can't compete in this realm because it kills their business model. And so it's what protects the industry, allows for a lot of experimentation to go on, whereas within Web 2, aside from what's going on with AI, I think a lot of startups have to kind of tuck around the major players. And even what we're going to see with AI is there's going to be even more data aggregation. I would like to see a world where I have an aggregation of all of my data, and then I can authenticate how different algorithms or services access that data. And also, if I have a full view of all my personal data, then I won't have to go and search for services on the web. Services, if I authenticate them, can actually bring the insight and things that I need directly to me. And so that architecture, which blockchains allow, is a world that I want to live in, and that I think most consumers would like to live in, whether they know it or not. And our only choice there is really to re-architect based on these open data layers.
What does it take for consumers to understand this? The average person probably would say, I don't know, as long as it's safe, I'm fine with whatever gives me the best performance, best UX. Does it take that last mile, the on-ramp that's beautiful and easy to understand, or what does it take for people to understand that?
Yeah, I think it's value, but to give the example, to talk more deeply about the question, we can use a real example, which is Twitter, right? So Web 2 Twitter today, we live in a dictatorship run by Elon Musk now, and Elon today can say, hey, I'm going to kill all the developer APIs that deliver value to the community because I want to make more money. He says, hey, I want to change the algorithm so my tweets show up more in your feed. And us as a community, we have very little choice. Not because we can't move over, because we can, but because, as Chris said, we hold all, they hold all the data. And so if you leave, you don't have any of the content anymore. You lose all your followers. You lose all your connections. And what blockchain allows is, in a world where Twitter were on blockchain, all that data would be freely accessible to all developers at any time. And so you could imagine there's hundreds of millions of developers building millions of interfaces that you as a consumer could swap from one interface to the next to find the perfect one for you without losing the content that you're receiving, without losing your followers, without losing your connections. And so all of a sudden you go from a place where you're locked in by a dictator to a place where you have freedom to move over, you have control, and innovation is happening much faster because there's all these different people competing on tools to deliver value. And so it's kind of, that's the world we live in, and to answer your question is we need more examples like this. We need to deliver examples where when someone interfaces with a Web 2 product and then interfaces with a Web 3 product, they feel that difference of, oh my God, here I feel like I have more control. Oh my God, here things are moving much more quickly and innovation is happening.
That's a very good one, because it also makes me ask you, what are the products that Dapper targets to do that? You speak a lot about the implicit magic of the experience, which both solves the equation of making it easy, fun, but also onboarding people that haven't had an idea about it before. So what do you work on? What's coming out of the Dapper factory?
Yeah, so where we've been mainly focused over the last few years was around this idea of digital sports collectibles. And what we were trying to focus there on was, well, how do we take a collectible and make it an order of magnitude better than what currently exists? And when we looked at sports collectibles, we looked at why people collect this sports memorabilia, and it's because they love sports, and what they love about sports is amazing people achieving greatness. And so we felt that if we could create a video collectible where you could kind of capture that moment that made you fall in love with that player, that made you fall in love with that team, we could create a better product than a photo on a piece of cardboard. And that was great for us, and that kind of got us to like a certain level of user base, a certain level of revenue. But there's still more to explore. Today, there's only so many things you can do with our collectibles. You can buy them, you can sell them, you can trade them, you can show them off. And so where we're really focused right now is adding more verbs of what you can do with these collectibles, whether it's us building it or community members, developers building it for us. And we're also looking at other kind of places in the entertainment sphere where we can kind of create another step function of we're delivering more value than you could have in the Web 2 world.
Would you call yourself a crypto technologist or an entertainment technologist?
A crypto technologist. Like, I think the magic of Dapper Labs is not that we're like an amazing entertainment company. We're not, and we hope much better and bigger entertainment companies come into our industry. What's really good, like what we've been really good at, is understanding a new technology, what it can offer to people, and making it easy for consumers or developers to interact with and really kind of feel that value.
Got it. Chris, maybe move over to your investing work a little bit. Well, how does your investment work actually take place? I scanned a little bit your website and your thinking, and you talk a lot about funding teams and networks. You deliberately separate the two fields. Can you tell us a bit what that means for your daily work, for the analysis that you do, your thinking around investments in the space?
Certainly. So the idea of funding teams versus networks really speaks to how closely together, at least in crypto, teams that launch crypto assets, they go from the private, say, venture-backed stage to a type of public market. And even though these teams can have a liquid, tradable asset, they're still dealing with venture-style problems, and they can still be they can even be at a seed stage. You know, they could be all the way through, say, the venture spectrum. And so even if we, say, help a team from the seed stage, and a few years later they end up launching a public asset, it doesn't mean that our work is done as a venture investor in crypto. Whereas in traditional venture, if you have a team that launches an IPO basically at that point, your work is done, and it depends on the venture firm, but you could sell your entire stake on, the day of IPO. Whereas for us, it's really the launch of the liquid asset is, maybe the beginning of the third inning out of, say, 9 innings of the journey. And so we'll put money in at the venture stage, but often we'll put in just as much, if not more money, at the public stage. Crypto is very cyclical, and so we may have a team that we've put, $1.5 million into in the, through different financings, or $3 million into, and then we might, put in an equal amount through a downturn. And some of this speaks to, like, if you look at a network like Filecoin or Ethereum or any of the hardware-based networks, actually supporting the network and the public crypto asset in a bear market also supports the infrastructure, and so the amount that the hardware providers earn. And so if the price of the crypto asset goes too low, then actually you'll have more and more hardware go offline, which could degrade the service of the network. And so that's where it becomes this combination of the core team that builds the software with also, funding the network itself.
How do you deal with the criticism, or how do you answer to the criticism that has come up, in not just in that and the downturn that we have, but also before that? The problem with crypto is that we have pre-product or early-stage product teams with unclear market perspectives, riding on late-stage valuations that are incentivized by completely liquid markets that makes them cash out or completely shift the incentives away from milestones to basically a sub-market economy on the individual network that's just stratospheric and makes no sense at all. How do you deal with these type of criticisms that I think are partially justified because they do move incentives around and you see the outcomes very clearly? But what's your perspective on it, and what do you expect how this might change in the coming cycle or the future of the industry?
Sure. Well, I'd say it's a valid criticism in the case of many projects. And I think one of the tricky things you have is, okay, so Bitcoin's around $30,000 right now. So fully diluted valuation is about $600 billion. And ETH is at about $2,000 right now. So fully diluted valuation is $240 billion. Those are massive numbers. And then you have networks that aim to compete with, say, BTC and ETH, and then they don't have that valuation, but even at 1/20th of the valuation, it's a very considerable multi-billion-dollar valuation. And you combine that with, the ability to create your own capital with your own supply and demand rules, and then you end up having, say, a market structure where, say, 10, 20, 30, 40% of the asset is circulating, and there's a large overhang. I would say in some ways, so that's a danger, right, certainly to be aware of as an investor. But I also used to work in public equities at ARK, where I would cover companies like Splunk, which at the time, through stock-based comp, was diluting the existing base 15% year over year for many years ahead, and you had no idea actually how diluted you're going to get over time, right? And so I would say that dilution is part of risk and venture investing, and especially in the more equity-like instruments. And crypto does it very transparently. If you dig in, you tend to know what the projected supply amounts are 10 years into the future, whereas we did not have that with publicly traded high-growth equities that were issuing a lot of stock-based comp. And so it's certainly something to be aware of. I don't think it's as new as people think. And then it's really just the difference between looking at a circulating network valuation versus a fully diluted network valuation. You can also have instances like Numerai, which Numerai was supposed to have 21 million hard-capped amount of units, and they decided to burn 50% of that. And so, with a single decision, they decided to have the potential amount of units that would ever be created because they recognize, hey, this is an overhang for investors. Long run, as more regulatory and legislative clarity, in particular in the US, comes on, you'll have more scaled capital, you have more hedge funds they will gang up on projects that are, let's say, vulnerable to these types of dynamics that we're talking about. And I think those projects will pay the price. So I think these things will be solved, and it's important we talk about them, but I don't see it as an inherent issue with the design or launch of a crypto asset.
What do you think, Mik? You're laughing.
Well, I mean, having lived through the problem, I think like one of the things that we tried, because there is this natural, there's the pain that investors go through, which I totally get, but there's also the natural incentive and hunger that an entrepreneur needs to have to get to product market fit. And like, frankly, like if you're sitting on millions of dollars and like shit gets really, really tough, at some point you might be like, okay, well, I'm going to go chill by the beach for a little bit or for a long time. One of the ways we try to solve this is by having longer lockups for our team members, such that like it's not a 3-year journey, a 2-year journey. We're saying, hey, it's a 10-year journey, and so yes, you're going to have a big prize at the end of it, but you're not going to get it all up front, and we're going to go on this journey together. Like my hope is that over time, investors and the market will start to demand that more from entrepreneurs, such that incentives are aligned for long-term value creation.
Yeah, I share some of these views. It's certainly difficult because you do have, a changed regime that felt distinctively end of cycle, and I think it's an interesting point to be introspective about this too, and probably move a little bit more to up the Web 2 world of milestone-driven things, and a bit of a different evaluation thinking. I'm looking at the time, so one last question to both of you that we discussed before, and if you were to do it all over again, what would you have changed or done differently? Mik?
The journey was so good. It's hard to say. I think that like when I look at one of our products, CryptoKitties, I think we would have had a longer term mindset of the economic models. I think but in all our products, the challenge you have when building games and entertainment products where users own their own assets is that you're dealing with an open economy, and that's really hard to control. And the rules that you make at the beginning dramatically affect that economy and dramatically affect how your first consumers enjoy that product and the last consumers that come in enjoy that product. And we made a lot of mistakes such that those experiences were vastly different. And I think we'd want to think about more how we smooth those curves out so that our products can have a lot more longevity.
And you, Chris, what would you change?
I wouldn't change a thing. I love it.
That's positive. Well, on that note, I think that's it. Thanks a lot.
Thank you.
We have time for a couple questions.
Oh, we have time for questions.
We have a bunch of questions here, so you can see the top 2 are the most upvoted. So if you want to go ahead, David, and read them. You can also see them here, David. David, right here in front.
Got it.
Maybe it might be easier.
Let me read through them.
If not, I can go ahead and read them
The
for
first
you.
one sounds a bit technical, so I might jump over it, if that's okay. It's got equal votes to number 2. Do you have a view? Do you have a take here? Re-onboarding is one more important than the other. What about distributed NPC networks? Hard to read. I'll jump to the next one. When Web 2.0 is dictatorship, Web 3.0 isn't Web 3 mostly unregulated capitalism instead of democracy? Discuss. Chris, you sound like the guy for this.
Sure. So Web 2 is dictatorship, not mostly capitalism instead of democracy. I would say that Web 3 is the programmable version of whatever we want, and you get to recreate the rules that we see or want to see in the physical, in the digital. And so right now, Web 2 operates mostly on the tenets of maximizing profit and equity capitalized companies that accrue most of the value directly to the early investors or public market investors and core teams. And I don't think that is the end model or even the optimal model for capitalizing networks. I think it's much better to aspire to including all stakeholders in the capitalization and the governance of a network. I agree that early on, in crypto's first decade, there's been just as much bad behavior as good behavior. But I also know, having studied the rollout of even equities themselves in the 1600s, or railroads, or automobiles, or even the fiber optic that we all rely upon today. There are these booms and busts and these periods of rampant speculation, of lack of regulation, where criminals are just as prevalent as innovators. So that doesn't make me stop aspiring towards building a more stakeholder-based form of capitalization and governance, which I do think Web3 sets us up for.
Got it. Maybe one last one of those. I guess the bottom one is most interesting for Mik. You can pick real-world assets or ETH and layer 2, 3. What do you like most?
Sorry, which one?
I wanted you to pick one, but let's pick the last one. How do you see the role of Ethereum and layer 2s and thirds stay dominant in NFTs? What can they not solve? What else is needed?
I think ETH has been amazing, and layer 2s have in a big way helped ETH be able to, developers be able to reach more consumers because of the cheaper fees. I think where we see value, in full disclosure, we built our own layer 1 flow, is we find it's still very difficult for developers to build complex applications. And I think it's one of the reasons why the main use cases are still assets moving back and forward, rather than seeing more computation happen on chain. And so we do see a world where applications are being run on chain. We think that kind of adds to composability, the ability for people to build on top of each other. And we think that other layers ones will come out or exist that will create easier make it easier for developers to build those applications. That could also happen at the layer 2, but we haven't seen that yet.
Awesome. Thanks a lot. That's
All right, David, Chris, Mik, thanks so much. Warm round of applause.